But I think we'll start. We're at 4:32 Saskatchewan time. So welcome everyone. We've got close to 500 people signed on already, and I know we had about a little over 1,000 or somewhere over 1,000 people sign up for today. But I think some of them will wait for the recording afterward. So based on the numbers, it appears that we've obviously chosen a topic of significant interest to our members to talk about. And in all seriousness, it's great to have so many of our members join us today. There's a lot going on in the world and in the markets these days. And so we're very happy to be able to have this time with you. Before we begin, we'd like to recognize and acknowledge that we are presenting from our office in Saskatoon, which is located on Treaty 6 territory in the homeland of the Métis. We pay our respect to the First Nations and Métis ancestors of this place and reaffirm our relationship with one another. We really appreciate the opportunity to make that acknowledgement and to pay respect both to the ancestors of this land, but also to contribute to the creation of a future where all those inhabitants of this land yet unborn can benefit and thrive together. Okay, thank you for allowing me to do that. And let me introduce who we have with us today. For those of you whom I haven't met, my name is Martin McGinnis, and I'm the Executive Director of CSS. With me today is Tammy Dove. Tammy is our Director of Member Experience, and she has responsibility for the administration and advisory functions within CSS, as well as our member experience strategy. We have Brent Godson. Brent is the Director of Investments and Financial Management for the plan. And Brent's core responsibilities are managing the plan's assets and interacting with the multitude of external investment managers that the plan partners with. Brent will be providing the presentation today. In the background, we have Nicole Quintel. And Nicole is our communications manager, and we have Kirby McInnes, who is our IT manager. They're helping us with logistics and technology for the presentation. And we certainly appreciate their support. Speaking of logistics, once I'm done with my introductory comments, we'll turn things over to Brent. And at the end of Brent's presentation, we're planning to have some time for Q&A. But we know we likely won't be able to get to all questions live. And so afterward, we're going to compile the questions into a list along with responses to those, and we'll send them out by email to all participants of the presentation today. We're also recording the session, and we'll make the link available afterward by email as well. We'll get those things out to you as quickly as we can afterward. You should expect to see them likely within a few days. You've also probably noticed that mics and cameras are off. And if you'd like to ask a question, please do so anytime during the presentation using the Q&A button in the Zoom interface. We'll address what we can after the presentation today. And if we don't happen to get to your question, as I said, we'll certainly respond to you afterward. We had originally called the presentation State of the Plan, and we were looking or intending to talk about investments, but also provide updates on some of the things we've been doing in the advisory area, on our website, in the member portal area, things like that. But given what's going on in the world and in the markets and how those things are affecting our investments, we thought you'd get the most value out of our time together if we focused on investments alone today. So we will, of course, continue to update you on those other things that we're doing at the plan through our website and our quarterly emails, TimeWise magazine, and other channels. And so if you're not signed up for those, I'd encourage you to do so. You can visit our website or give us a call for more information on how to get connected with those channels if you're not already. Okay, that's enough for me. I know Brent has a lot of that he wants to share with you. So let me sign off and turn things over to Brent. And I'll just say thanks again for joining us. I think you're going to really appreciate the information that Brent has put together for you. Brent, I'll turn it over to you.
Okay, thanks, Martin. Good afternoon, evening, everyone. I'm going to dive right into the presentation because, as Martin said, we've got a lot to go through today. Just a brief outline of what we want to try to accomplish. First, we want to take a look at some of the plan's key investment beliefs. This will provide some important context when looking at our portfolio and how we manage that portfolio over time. Secondly, we want to look back at the market environment that existed prior to 2021, some of the trends that will be important to consider when evaluating performance. And then we'll specifically look at 2021. We'll look at the performance of the balance fund. We'll dive a little bit deeper into the underlying components of the balance fund and how each of those performed relative to their benchmarks. And hopefully get some idea of what the leading contributors and detractors to performance were in 2021. Then we'll spend some time evaluating that performance, talking about some of the things that we're looking at and considering as we evaluate performance relative to benchmark in the recent past. Next, we'll bring you up to date. What's happened so far here in 2022? What's the outlook beyond that? And again, how is our portfolio positioned relative to those views? And then finally, just a slide to recap what we believe we add in terms of value for our membership in the balance fund relative to retail products in the marketplace. So first thing, key investment beliefs. First of all, we maintain a long-term investment horizon. This is a pension plan investment portfolio. We're investing for our membership during the contribution phase for 40 plus years. We're investing again for our members through retirement phase for potentially another 30 plus years. That really gives us that long-term investment horizon, which helps us look past short to medium term market noise and volatility and focus on our long-term goals. Secondly, as a fiduciary, protection of capital is at the heart of our investment strategy. Although we must accept some level of risk to earn the returns necessary for an adequate retirement, we look to investment approaches and styles which improve downside protection, give additional margins of safety, maximize return per unit of risk that we take. Thirdly, diversification is central to mitigating risk. We really look to diversify as much as possible across asset classes, across public and private markets, geographies, sources of risk and return, and investment approaches and style, again, to mitigate risk over the long term. Expense management and control is critical. I think this has always been a key tenet of the plan. These days, we not only look to minimize expenses, but where we do incur expenses, we look to maximize the value add for our membership. We construct our investment strategy in part by learning from the past. Here, we're really leveraging academic and empirical research around investments to give us the best probability of success in the future. And I think you'll see how we use that in the presentation today. Next, discipline is key to the investment management practices and processes. This is really about the fact that successful investing often is hampered by human emotions. Think of fear and greed. Really, we use discipline to provide a barrier against those human emotions, help us step back and explore what the best path forward actually is. We believe in a responsible, sustainable investing approach is in the best interest of our membership. This has had a heightened interest in recent years. We really look at environmental, social, and governance issues as creating both risks and opportunities for our portfolio. And we look to integrate those risks and opportunities into our investment processes with a view to enhancing performance. We look to establish long-term relationships with high-quality investment partners. We don't make security selection decisions here at the plan. We engage investment specialists in each of the markets in which we invest to make those decisions on our behalf. we spend a significant amount of time and resources in identifying and ultimately choosing those managers. And we really look to build long-term relationships with them. But as part of that process, we regularly review and monitor performance going forward. Finally, member outcomes are paramount. So we study behavioral finance and other disciplines to help us understand member behavior, leverage this knowledge to design our strategies, products, and education to mitigate the most harmful outcomes and increase our probability of success. So that's our investment beliefs. I think we can think about those as we go through the presentation today. The next thing we want to look at is what are the market conditions or market environment leading into 2021, and what was our fund positioning relative to those conditions. So I think the first thing that we have to talk about if we're talking about investment environment is low interest rates, getting even lower through the pandemic. So ever since the financial crisis in 2008, we've been in a very low interest rate environment. And as the pandemic came along, those interest rates dropped to near zero as central banks around the world tried to stimulate investment. Those low rates on this next slide, we can see help stock prices reach their second highest level in history. This is the Shiller PE ratio. It's academically accepted as one of the best way to compare stock prices or valuations over time. And we can see that at the March of 2021, when this chart is from, stock prices were at elevated levels, second highest in history, only to the tech bubble, higher than the 1929 stock market crash. That's further research on that tells us that most of those valuation increases that we were seeing in the marketplace were in what we refer to as growth stocks. The other side of the market, value stocks, tended to be underpriced relative to history. That's important in terms of our portfolio, because we tend to lean into value stocks and the value style of investing, because consistent with that protection of capital investment belief, historically, those stocks, that style of investing, value style of investing, has provided better downside protection, margins of safety, lower volatility characteristics that we believe DC investors favor. If we dive a little bit deeper into that growth versus value dynamic, this chart will help us understand what's happened in recent years. This is over the last 25 years from 1995. When we look at the blue line here, this is the performance of growth versus value. So when the line is going up, growth is outperforming value. When the line's going down, value is outperforming growth. So if we go back to 1995, we can see the period leading up to the tech bubble, or the dot-com crash in 2000 was a period when growth outperformed value. When those market valuations returned to more normalized level, we can see that value outperformed growth for an extended period of time, all the way up until the 2008 financial crisis. And since that point in time, we've kind of seen a steady outperformance of growth that really accelerated around 2018 and actually spiked during the pandemic, only to see value outperform growth late in the fourth quarter of 2020, when vaccine announcements were made and there became more optimism in markets that economies would return to normal. So in addition to that growth versus value dynamic that we've seen in recent years, we've also seen more concentrated markets. So on this slide, We look at global market concentrations. This Herfindahl-Hirschman index, again, is academically accepted as a measure of market concentrations. And as of August of 2020, concentrations in the markets peaked, although they're still very high. Again, concentrations here at this time are much higher than they were during the tech bubble, which we know did not end well for investors. To give you an idea, a few more specifics, in the US, which is one of the most concentrated markets, as of 2020, the largest 10 stocks held 27.4% of the market value of the S&P 500 index. So that's a 500 stock index. 10 stocks held 27% of the market value of that index. And in 2020, Apple, Amazon, and Microsoft, 3 companies, accounted for more than 53% of the S&P 500's total return in 2020. For passive investors or somebody who is invested directly in the S&P 500, that should cause some level of concern. From a prudent portfolio perspective, that concentration level in those small number of names, all within the tech sector or having tech-like characteristics, should create some concerns. What else was happening? Well, in the pandemic, in 2020 specifically, we saw the pandemic create certain winners and losers in the marketplace. Generally, the pandemic, which is a fundamental shock to the market, created winners, particularly those companies with less tangible assets were the winners. Those with more tangible assets on their balance sheets were the losers. The nature of those lockdowns and work from home mandates also created some specific winners in the marketplace. Think about Zoom video that we're using here today. As businesses look for ways to interact with employees and partners from home, Zoom video usage skyrocketed. Think about Netflix and other streaming video services as people look to supplement their entertainment in a lockdown world. Subscriptions there skyrocketed. And here in Canada, a company by the name of Shopify saw its valuation increase. Shopify is an e-commerce company that helps small businesses create online presences through website development, payment service, logistics, and delivery services. And Shopify had been growing at a fast rate prior to the pandemic, but in a world where small business sought ways to supplement the lack of in-store traffic, Shopify was the solution, and again, saw subscriptions to its services increase on the year substantially. Shopify stock increased in price 178% in 2020. That ultimately not only made it profitable for the first time in its history, but also allowed it to displace the Royal Bank as the single largest capitalized stock on the S&P TSX Composite Index. To give you an idea of how that type of performance affects our own portfolio, neither of our managers in the Canadian market own Shopify, not necessarily because they didn't believe it was a good company or would be a successful company, but because they believed the price you had to pay for that stock wasn't supported by its long-term fundamentals. Ultimately, not owning Shopify in 2020 resulted in a single stock underperformance relative to the benchmark of 4%. In other words, each of those managers underperformed their benchmark simply by not owning that stock to the tune of 4%. Finally, what else were we seeing in markets in addition to this growth versus value dynamic, concentrated markets, pandemic winners and losers? We started to see investor behavior become more speculative, almost euphoric. Those types of investor behavior are consistent with late stages of an asset bubble formation. So I've got on this slide a quote for you from the Globe and Mail, really talking about when you see your teenage cousin living in the basement, talking about trading stock options. That's usually the sign of a market bubble. And that, in fact, was happening in the marketplace. I've also got a number of other signs here of potentially an asset bubble forming. The Bitcoin crypto investing frenzy, a surge in retail trading, corresponding use of leverage in those trades, fourfold increase in non-profitable technology stocks in innovative industries on benchmark indices, the rise of what was previously a relatively unknown investment vehicle called SPACs, or special purpose acquisition vehicles, and the first day price increases on those vehicles. These are investments with no history, no assets, only a business plan to acquire assets. The amount of initial public offering volumes up, people coming to market trying to take advantage of high valuations, and the first day performance on those IPOs being the best since the tech bubble. We saw the GameStop saga early in January of 2021. This was where a group of retail traders on a social media platform, Reddit, ganged up together to drive up the price of GameStop and other stocks. Some 1,700% in the case of GameStop in January 2021 alone. That price increase, of course, bared no relationship to the underlying fundamentals of that company. We also saw the popularity of green technology and EVs drive up stocks to implausible levels, all kind of signs of potentially asset bubble forming in the market. So remember, our preference is for those investment styles which protect capital, have better downside protection, lower volatility, and are more broadly diversified. I think those slides that we've just gone through give some indication that the market conditions were really not suited to our portfolio preferences, not only in 2020, but in the years leading up to that in 2018 and 2019. So with that understanding, let's get into 2021 performance. Again, I'm going to concentrate here on the balanced fund. We'll look at the 1 year first. The balanced fund, 9.43% on the year. Its benchmark is really a roll-up of the underlying components of that balanced fund and their respective benchmarks at target weight within the portfolio. That benchmark equaled 11.11%. So underperformance relative to the benchmark of 1.68% on the year. In a moment, we'll dive a little bit deeper into what the leading contributors to that underperformance were. On the 4 year performance, you can see 5.32% performance, annualized performance for the balanced fund. Again, its benchmark here was 7.7%. So an underperformance of 2.45% on an annualized basis over that 4 year period. That is material, and that is something we want to talk about more a little bit later in the presentation and give you some understanding of our views of that. That significant level of underperformance in the medium term has also driven down our 10-year performance to be below benchmark by 0.51%. We do have a secondary performance benchmark. That's a return objective of inflation plus 4%. And over the last 10 years, we've more than met that particular benchmark. So let's just revisit this growth versus value chart to give you an understanding of what might have changed in 2021 with respect to growth versus value. When we last looked at this chart, we had seen vaccines announced. We saw value start to outperform growth. That outperformance by value actually continued into the first quarter and the second quarter of 2021. But as we started to see more concerns related to the new pandemic variants, Delta, and then subsequently Omicron. We started to see growth outperform value again. So a much more mixed year in terms of this growth versus value dynamic than we saw in 2020 or even 2019 and 2018. To give you a little better perspective as to how that growth versus value dynamic affected the portfolio in 2021, what I've done on this slide is I've used the MSCI Growth versus Value Index in all the markets or geographies in which we invest, compared those two, and then I've shown also our CSS performance relative to benchmark in those particular markets. So if we start at the top in the US large cap market, we can see that growth outperformed value by less than 2%. That's certainly less than we've seen in recent years in terms of the outperformance of growth. Our manager within this market is what we call a multi-factor manager. Those multi-factor managers really target investment characteristics or factors that have persistently outperformed the broader index over the long term. Those factors include things like value over growth, but also momentum, quality characteristics, low volatility characteristics, and smaller size than the market index. So in 2021, I think you can look to primarily the fact that the portfolio was more diversified, not as concentrated in those big tech names that dominate the US marketplace. And because of that, ultimately underperformed their benchmark in 2021. If we go down to Canada, the story's a bit different in Canada. A different marketplace, not as large as tech sector. We have Shopify that we talked about, but not a lot of names after that. Our big sectors within the index are financials and energy. And energy and financials both had very good years in 2021. Those sectors also tend to have more value names in them, and correspondingly the two active value managers we have in Canada outperformed their benchmarks on average by 4.95%. US small cap market, again, different than the large cap space. Value outperforming growth according to the MSCI indexes by a rather substantial margin. Again, we've got a multi-factor manager in this investment space, outperformed their benchmarks by significant margin, over 27%. And so that even though that this small cap US market is a larger or a lesser target weight within the portfolio, it managed to offset the underperformance in the large cap space in the US market. In EFI markets, this is developed markets in Europe, Australasia, and the Far East. Growth outperformed value in those markets. We have two managers here. One is a value manager, one is a multi-factor manager. On average, those managers underperformed their benchmarks by about 3.90%. Again, smaller size and value outperformance, value positioning would have been some of the reasons for the underperformance of those managers. But in addition, both those managers invest off benchmark in emerging markets within their portfolios as well to a certain degree. And that exposure would have hurt during 2021 because as we look down another line, we can see that EM markets didn't produce near the same returns as developed markets, specifically those in North America. And again, that can be related back to the pandemic, at least in part. Emerging market countries were farther behind developed countries in terms of getting vaccines into the arms of their populations. Our manager within this market exhibits the most growth style bias of any managers within our portfolio. They've actually outperformed in 2020 and 2018 and 2019 as well. So it's not surprising, given the changing dynamics in this market, to now favor value investors, that they would underperform in that type of environment. This slide takes a look at the balance of the components of our balance fund, those components within fixed income and alternative investments or real estate. We can see again that this is mixed performance across those various allocations. I'm going to focus on the last two here because these are really the two leading contributors to underperformance of the balance fund to its benchmark on the year. The BlackRock Emerging Market Debt portfolio was added around 2018, again, to try to diversify our fixed income portfolio looking forward over the long term, generate some more returns for fixed income. Because this is emerging markets, we do expect more volatility. And in 2021, we can see that was weaker performance for the fund, minus 11.52% on the year. The important thing, though, when we're looking at this particular mandate is the benchmark that we use for this mandate. It's not a market-based benchmark. This is an absolute return benchmark, or a long-term return expectation for the fund. So this is Canada Deposit Overnight Rate plus 5%. And when you look at a level of underperformance that we had in that portfolio in the year relative to that benchmark, almost 17%, at a 7% market weight in the portfolio, about 1.2% of the underperformance we saw in the balance fund can be directly attributed to this particular mandate. So 1.6%, 8% underperformance in total at the balance fund level. We can directly attribute a 1.2% of that to this specific mandate. The other leading contributor to underperformance was the currency overlay mandate that we have within the portfolio. Mackenzie Investments manages that for us. We hedge approximately 50% of the developed market foreign currency exposure in the portfolio to reduce foreign currency risk. Mackenzie actually actively manages that, so they can actually overweight or underweight those hedges based on the views of their model, which looks at valuations, sentiment, and macroeconomic conditions. But you can see that didn't work in 2021. Actually had a large, significant level of underperformance relative to the benchmark. That's material because that developed market foreign currency exposure is quite large, about $1.9 billion within our portfolio. So again, those would be the two leading contributors to underperformance in 2021. So I think we want to spend some time talking about how we evaluate the underperformance, particularly in the 4-year period where we've seen kind of persistent levels of underperformance. Some of you may look at that underperformance and conclude that the obvious solution is to make changes, terminate managers, change investment strategies. We instead look at that underperformance to benchmark as more as a warning indicator that requires further investigation. We need to really dive deeper into our understanding of the market conditions, and as well as the characteristics of our portfolios, to help us, to the extent possible, are these temporary market conditions that are likely to revert back, or has the world changed somehow? And do our long-standing investment strategies no longer, should we expect them to provide benefits to the portfolio? Or we look at things like, is the underperformance due to a lack of skill by our managers? Or alternatively, are our managers doing exactly what we hired them to do, which in this case would be to protect capital? So we don't have a lot of time to go through all of the things that we look at, but I thought I'd show you a few slides here to help give you some perspective and some idea of what we are looking at. So again, back to this growth versus value dynamic. This chart from Research Affiliates is over even a longer time frame. We go back to 1963, so almost 60 years of history. We're going to focus on the green line in this chart. And what this chart does for us is it provides us a little bit better perspective as to where historically, under what market conditions or in which market environments we see growth outperform versus value. So this chart's a little bit different than the last one. When this is value versus growth. So when the line's going up here, value is outperforming growth in all these periods. And alternatively, when the line is going down, growth is outperforming value. And we can see that from the work that Research Affiliates has done, most of the movement or the outperformance of growth comes in those periods leading up to asset bubbles forming in markets, and values outperformance tends to come in the periods that follow when those asset or price bubbles burst. So the Nifty 50 period, we're going to talk about a little bit more in a moment, was a period where an asset bubble formed. The oil crisis, the biotech bubble, the tech bubble, the global financial crisis, when a bubble formed in the housing markets, all were areas where we saw growth outperform in the period leading up to that, and then value subsequently outperform. We're currently in this period where we've kind of had a low level of outperformance by growth accelerating through 2018 and then through the pandemic even spiking even further. And this, as to June of 2021, gives us an idea that value at least had started to recover in markets. So again, the question we're asking ourselves here, is this current period that we're in another asset price bubble, which we would expect our value biases to outperform as the equity portfolio reverts back to longer term means in terms of valuations? Or has the world changed somehow? Is something fundamentally different now that again makes this value dynamic no longer work? This is a slide that tries to emphasize the risks if we are in a asset bubble of changing strategies, jumping on the latest winners to try to gain back performance. So if we look back to the dot-com bubble, we can see that the entire market wasn't affected the same when the crash did occur. Large cap growth companies and technology stocks plunged, while value stocks actually had gains during that time frame. So the reference here in this slide is to the tech-focused NASDAQ Composite Index. It fell 39% during 2000. I think it fell another 40% during 2001. While alternatively, the Wilshire Index during that same period in 2000 gained 17%. So obviously, there's some risks to what we know a lot of retail investors might do would be to chase returns and jump into the latest winners. That certainly wouldn't have worked during the dot-com crisis and would lead to further underperformance relative to benchmark if we took that action in this market or in that market. A little more just on that same line of thinking. Again, if we look back to the dot-com bubble and the top 10 tech companies in the index at that time, names like Microsoft, Cisco, Intel, IBM, that are still very sound and profitable companies. Only one of those companies, Microsoft, was able to beat the broader S&P 500 index over the next 19 years. All the others failed to perform at levels as that broad market index going forward. Microsoft actually took 18 years to regain its 2000 high. The NASDAQ took 15 years to regain its 2000 high. You know, we've talked here a lot about the dot-com bubble. I want to give you, again, a little better idea that there are similarities to other market or asset bubbles that have formed in markets in the past. This is the Nifty 50 that was referred to in the other slide. Again, some more similarities to today's investment environment here. Was a period during the 1970s when investors became enamored with big blue chip stocks and high growth characteristics. Yeah, ultimately, they felt those particular blue chip stocks were so dominant that the price you bought them at didn't matter. That drove up prices on those particular stocks, you know, to some 42 times earnings, where the broader S&P 500 market was only at 19 times. And ultimately, that meant those names, when valuations did revert to long-term norms, were hit harder than the rest of the market. And again, you can see from the slide here some of the names that were included in that Nifty 50: Coca-Cola, Xerox, Walt Disney, McDonald's, American Express, and all fell from, you know, in excess of 60% to in excess of 80% when markets did crash. One more slide along these same lines, similar to ones that we had in previously, and that is, how long does it actually take for broad markets to recover from these asset bubbles when they do crash? This is, again, is the S&P 500, and we can look to, you know, some of those ones that we've referenced recently. The Nifty 50 crisis took the S&P 6 years to recover from those declines. The tech bubble, 8 years. The financial crisis, it took 6 years to recover. That's particularly important for us to keep in mind and cause us some level of caution. We have a significant percentage of our membership either nearing retirement or in retirement. Those types of extended periods for recover can really be detrimental to those of our members who are in retirement or in the spending phase with their portfolio. So, you know, that the question we go again, we don't know what's going to happen here next in these markets. It's certainly going to have some type of difference to past markets, but there are also a lot of similarities to previous asset bubbles that I think should give us caution and let us protect portfolios going forward. One last slide in this section, and that's to look back at our own experience, our balanced fund, and this value bias that we've had within the fund has been in existence really ever since we've started investing in equities. Certainly was in existence prior to the dot-com bubble. You can see at the top of this slide, I referenced the balanced fund return, you know, leading into the dot-com bubble bursting, underperformance in the portfolio at quite significant levels for those 2 years. And it's important to keep in mind that we had less equity exposure than we do now in the portfolio, and less equity exposure, particularly within US markets, which was the kind of epicenter of the tech bubble at that time. So when we look to today's performance, although it's been extended over a 4-year period, the total level of underperformance relative to benchmark compared to 1998 and 1999 is quite similar. Once again, we don't know what's going to happen next, but in the absence of any clear evidence that this time is in fact different, we defer back to that investment belief that we talked about before, which is discipline to our investment strategy. So let's move on now, away from past performance and to looking forward. What's happened so far here in 2022, and how has our portfolio performed, and as well, what's the outlook beyond that, and how is our portfolio positioned to those views going forward. If we again look at this growth versus value chart, where we left off, Delta and Omicron had started to put fears into markets. We saw growth outperform value again. But as we roll into 2022, again, we see more optimism in markets, restrictions lifted around markets in terms of those variants, and value outperforms growth again. If we revisit the MSCI growth versus value indexes in all of those markets in which we invest, you can see that value is outperforming in each of those markets. And all of our managers, with the exception of EM, which is again the one that exhibits the most growth characteristics, all of our managers are outperforming their underlying benchmarks. So optimistic performance for year to date for our portfolio, certainly the equity portfolio. What about those pandemic winners? Have they been able to sustain their growth? Well, so far in 2022, Shopify is down 65%. This is as of last Friday. I think if you go back to November of last year, they're down some 75%. Zoom down 46% as of last Friday. Netflix down almost 68% as of last Friday. So again, some of the growth that was projected based on that very unique market environment, these companies haven't been able to live up to recently. And again, our portfolios who didn't invest in as heavily in those types of companies has been the benefactor here so far in 2022. Some of you might question, well, is it done? Is the outperformance of value done? Again, if we look back to this Shiller P ratio and where we're at, we're currently at 32.7, certainly down from the recent highs, the 34 that we looked at as of March 21. We've come down a ways, but we're still elevated, still quite high relative to the recent 20-year average of 25.9, which would imply there's more room for valuations. Again, most of those valuation excesses being concentrated in growth stocks to come down. This slide now takes us into forward expectations. What are return expectations for various asset classes going forward? This is from BlackRock, but I think these expectations are very similar to our other partners and consultants that we review. If we look at the equity asset classes in particular, we can see that there's a kind of a change in regime. During the 2010s, certainly the winner in terms of asset class performance has been US equities, driven by and large by those mega cap tech names, and the performance in those particular names has made them the top performer in the 2010s. But BlackRock, you can see here, doesn't believe that performance will continue. And in fact, we see a leadership change from the US, which is now the laggard in terms of expectations, over to emerging markets and European equities, which have annualized return expectations some over 3% in excess of US equity markets, according to BlackRock. And that's consistent with what we know from history again. If you look at the 1990s, the US was the clear winner. If you look at the 2000s, the US became the laggard. And it was Canada, EM markets, and European markets that posted the best returns during the 2000s. That reverted back to the US in the 2010s. And again, the expectation here from BlackRock is that that will revert again going forward. The other thing I want to talk briefly about here is just fixed income return expectations. In terms of, this is the central return expectations for, it looks a little offline here, but for Canada bonds, aggregate Canada bonds, which is our Canada universe. BlackRock believes over the next 10 years, the annual return expectation for that particular asset class is only 2%, whereas the return expectations for other fixed income asset classes like emerging market debt, US dollar denominated or locally denominated, as well as US high yield, is much higher at 4.5%. Overall, these expectations, I think, bode well again for our portfolio. First and foremost, we're more diversified within US equity markets, not so concentrated in those big tech growth names. We're certainly allocated both in EM markets and European markets specifically to be able to take advantage of those increased returns. We have dedicated EM debt exposure within the portfolio and to some degree high yield exposure as well. We've reduced our Canada bond exposure in the recent past. This next slide is really about why those bond return expectations are so low going forward. And that's really the recent rise of inflation risks and interest rate risks. Again, if you go back to that very first slide that we looked at earlier in the presentation, we talked about the extremely low interest rate environment that we were in. There was always going to be a point when we had to revert those interest rates or normalize those interest rates over time. But recent inflation readings are really pushing to increase the pace and the level at which interest rates rise. So we started to see inflation readings and interest rate expectations edge up in 2021. As a result, our Canada Universe Bond Index here posted a negative 2.5% return. We haven't seen many negative returns over the last 30 to 40 years within Canada bonds. This is one of the worst. Here in 2022, as we continue to see these inflation readings move up and central banks around the world indicate that the pace of interest rate increases continues to accelerate, and the level at which those rates are expected to move increases. We've seen that Canada Universe Bond Index actually post a year-to-date return of minus about 10.7%. So very different markets, looking forward than we've experienced over the last 30 or so years. I thought on this next slide, we take a moment just to talk about inflation and how our portfolio is positioned relative to inflation risks, given they are such a big issue in markets today. This is from BlackRock. It is recommending how a portfolio be constructed to mitigate those inflation risks. If we look at fixed income, the recommendation is that we consider unconstrained strategies and inflation-linked bonds. In late 2021, We actually reduced our exposure to Canada Universe bonds, as I mentioned, and funded a new portfolio within the balanced fund and within the bond fund. It's a new unconstrained bond portfolio. This is a slide from Wellington Management, who's the manager. I've presented it here because I think it gives you a good understanding of the number of fixed income markets that they're able to access within this portfolio and to actively manage over time from year to year based on market conditions to try to optimize returns going forward. And one of those areas or markets that they can access is inflation-linked bond as recommended by BlackRock. Equities, the recommendation here is to focus on value-oriented equities and quality equities. Well, I think we spent this entire presentation talking about our tilt towards both of those investment factors. On the commodity front, they're suggesting that you seek out exposure to commodity futures and commodity-related equities. We don't have exposure to commodity futures in the portfolio, but we do have a significant weight in commodity-related equities, primarily our Canadian equities and our emerging market equities in our portfolio. They also recommend real estate, lean into core real estate and real estate debt. We didn't talk about them much, but if you look at that slide that refers to all of our real estate and fixed income portfolios within the balanced fund, you can see that we do have investments within core Canadian real estate and within real estate debt in the form of commercial mortgages. Those have been very good performing assets or funds for us. And we have actually continued to look to expand our real estate investments. We conducted a search in 2021 for new global real estate managers. We actually landed on two, the TD Asset Management and UBS. We're currently in legal and documentation with those two managers. Hope to be able to fund those over the next 6 to 12 months. And then finally, in terms of recommendations from BlackRock, infrastructure, they're suggesting that portfolios explore infrastructure as a diversified source of portfolio return, particularly because it has often infrastructure has explicit links to inflation through fixed contracts. And similar to global real estate, we did conduct a search for infrastructure mandates in 2021, actually have committed now to both JP Morgan and IFM investors. We expect to fund those again over the next 6 to 12 months. So that is the bulk of the presentation I have for you today. I've got one more thing before we open it up to questions. I did want to just review how we believe we add value for our membership, relative to retail products over the long term. I hope you get a little better understanding of how we look at our performance relative to benchmarks, but these are the things, again, in the long term, we think we add or can add for our membership. First and foremost, at the left-hand side of the slide, cost efficiency, no profit motivation. We're a $5 billion fund that gives us a lot of leverage in institutional markets to gain pricing advantages, certainly over what we can obtain in the retail marketplace. We deliver those to our membership without any profit motivation. That leads to a significant reduction in expenses over what you would get in the retail marketplace. I've referenced here about 2.25%. I think it might be the starting point for a similarly diversified balanced fund in the retail marketplace. We think that over time, over the long term, is going to compound and add up to significant value added for our membership. Secondly, increased diversification. You simply will have a difficult time finding the level of diversification that you have within this fund, within the retail space. Access to private markets that we just talked about is very difficult to find within retail products. Diversification across multiple managers, geographies, asset classes, investment styles, simply very difficult to get that level of diversification out there in the retail space. We do believe in active management. We do believe that that will add value over time. That is certainly the history of the plan. We have some certain advantages over retail investors here as well. Again, that size gives us access, direct access to the investment teams in each of these markets, not only during the selection phase, but during the monitoring phase. I can pick up a phone and talk directly to the investment team to get a better understanding of what's going on within those portfolios relative to benchmarks. We certainly have the advantage of working with world-class investment consulting firms, Mercer, Aon, and B Finance, to help us with the selection, the monitoring, and where necessary, the termination of any of those managers. Institutional portfolio construction, risk versus return. Every 4 to 5 years, we are re-examining the portfolio, remodeling our existing portfolio, as well as numerous iterations of alternative portfolios with different asset classes, different weights within those portfolios, comparing those across a number of different risk and return metrics. In addition, we're doing scenario analysis on those portfolios to understand how each will perform in various market conditions, like a credit crisis, or an oil crisis, or an emerging market crisis, or even climate change scenarios. Next, mitigating behavioral biases. We spoke to this earlier. Our knowledge and awareness of those behavioral bias, we not only use in the management of our own portfolio, but through our advisors, through our resources that we make available to members, through our education, we help support members to try to mitigate those behavioral biases and maximize their retirement outcomes. And then finally, just the structure of the plan, the fact that we have defined investment beliefs, policy, and strategy, the fact that we have the board oversight really gives us the structure and the discipline to stay the course, to add value over the long term. So with that, I'm going to turn it over to Tammy, and hopefully we can try to address some of your questions.
Thank you, Brent, for that. That was really good. We do have a few questions, and there are 1, 2, 3, 4 sort of themes that are happening here within the questions. The first question theme that I'll start with, it actually deals with those rising interest rates and its impact on the balanced fund and the bond fund came up. I'll read all 3 questions out, and then Brent, perhaps, and Martin, you can answer them. The 3 questions are related to this. Is the balanced fund contains about 23% bonds. Over the last couple of years, the inverse correlation between equities and bonds has changed. They now appear to be moving in the same direction. How has your team addressed this? The next part of this same theme, what are the implications of interest rates going up for the fixed income portion of the balanced fund? And the last one related to the same theme, the concern is with respect to bond performance with rising rates.
Yeah, so I'll try to address that. Maybe Martin, you can chime in. I really think the last part of our presentation addressed most of those questions and concerns. So in terms of the changes we've made to the portfolio, or what we're doing regarding this new environment, low return environment, rising rate interest rate environment, is we've moved significantly away from Canada Universe bonds as our major fixed income component in the balanced fund. If I go back to my early days here, that was the only fixed income benchmark that we had. It was 40% of the portfolio. So over the last number of years, we've we've recognized or seen forecast this change in environment that would happen, although we didn't know the exact timing of it. But you've seen us make a number of changes as a result. Emerging market debt, which I talked about, is one of those, again, expected to be a bigger return contributor to the portfolio. The recent one that I talked about, the unconstrained bond portfolio, again, adding some additional flexibility, active management, additional resources for the investment manager to try to generate more returns from fixed income. We've seen commercial mortgages added to the portfolio in 2016. Again, we believe that portfolio, which has less interest rate risk, less duration than a Canada Universal Bond Index, for example, and we generally expect it to outperform by a further 1% to 2% relative to similarly markets with similar duration. So that would be another area. Overall, we've reduced exposure to fixed income in general from the 40% I talked about back when we had the financial crisis. We've reduced that exposure, added some alternatives in part to generate some more income to help this in this low interest rate environment. What can we add there, Martin? In terms of moving forward, interest rate risk, a lot of what we're seeing right now in terms of markets reacting to these increased expectations for interest rates is likely to be most of the adjustments that we see going forward. We don't expect negative 10% returns that we've seen year to date here to continue to move forward. At some point, market expectations will align with what central banks are doing around the world, and we'll start to see that moderate, I believe. So I think the expectation more in line with the long term is something like we see from BlackRock in the slide that I provided to you. We expect to see more like 2% to 3% returns from fixed income markets and the Canada Universal Bond going forward. And hopefully those different mandates that we've included in the fixed income portfolio can add value over that.
I have nothing to add to that, Tammy. So
Okay, thank you.
That was good.
Thank
Thanks,
you.
Brent. Yeah.
A few more questions also popped in as we were doing this. And I did want to mention that if Martin does pull the cord and say that our time is up, we will be sending out the list of questions and answers as well to the attendees, because in case we don't cover all the questions.
Yeah, there's some good ones coming in here right now. And if we don't get to them, we certainly do want to respond. I think they'll be relevant to a lot of folks on here. So
exactly. Yeah,
we'll certainly do that. So yeah.
One of the earlier questions that came on, it starts off excited. It says, hello, my research has also shown that tilting towards value is a solid investment strategy, but I've also seen that active management over the long term will not beat a passive investment strategy. My question is, instead of using managers to guess if currency should be hedged or if Shopify should be in the portfolio, has CSS considered a solution like an all-in-one ETF solution offered to retail investors? You won't beat the market with this strategy, but you also won't shouldn't underperform.
Yeah, I can try to take that. So again, our research is a little bit different. I think if you go longer term, certainly at the institutional level and the prices we pay for services, active management has added value. Certain markets more than others, but in general, at the institutional level, I think active management has actually added value. Most of the research that you see out there is related to the retail marketplace, where expenses, the MERs that I talk about, play a much bigger role in determining whether active can beat passive. So that's number one. I do think, passive investment over the last 10 years has done very well. Again, our long-term horizon is longer than 10 years. And again, from the presentation today, we think there's certain periods of time historically, like the tech bubble, like the Nifty 50 crisis that we talked about, where it's in the best interest of our members not to be invested like the market. And we talked about a lot of those concerns in terms of recovery periods, overall performance. We have added value within our balance fund historically, based on the active management that we use within it, even though we've had a period of recent underperformance here.
I'll just maybe just comment too that we'll go through stretches like this. It feels pretty awkward, and that's where that discipline comes into play to stick to your knitting. And we've got this defined philosophy that we use to our investing, and so we go through stretches where it doesn't feel very good because the market's not rewarding what we're doing over those shorter periods of time. But as Brent was saying, just when you look at it over the longer term, which is where our focus is, it does pay off for us.
Okay. I'm just looking through the ones that are trickling at the end here too.
How are we doing for time here?
Yeah, how are you doing for time? Do you want to do one more?
Sure, let's do one more. Yeah.
Okay. I will pick this one.
Mhm.
Some retired members have split their portfolio into equities and bonds, which normally allows them to lock in gains in the respective portfolio and avoid locking in losses in their portfolio. When they are mixed in the balanced fund, you are sometimes locking in losses. Why can't you split out the new additions like real estate into their own portfolio, like you have done with the equities and bonds?
Yeah, unfortunately, one of the issues with infrastructure and real estate, those private market investments, is they're very illiquid. They only reprice periodically. And as a result, if we were to be able to split them out, we wouldn't have daily trading. It introduces a number of other complexities in terms of how we manage those funds. You'd be locked into those for extended periods of time, very similar to the way we're locked into them at the institutional level or at the CSS plan level. If they're in the balance fund and they're a much lower level of allocation within that fund, then we can manage around some of those issues related to liquidity and stale dated pricing. That's really the big issue. I'm not sure that that you're necessarily harming yourself that much by investing directly in the balance fund versus separating out those equity and bond portfolios. And certainly I believe that exposure to those alternative assets and private market assets would be important to gain access to.
All right. Is that it for
Okay.
questions then, Martin?
Yeah, I think just being mindful of people's time, I think we had committed to an hour or so, and we certainly exceeded that. So we'll end here, but just a quick reminder, you can expect an email with the Q&A portion recited and responses given, and we'll send that out to all participants that had registered, as well as a link to the recording of this video as soon as it's ready. So, and again, can expect to see that I think in a few days here. Keep in mind that especially if we didn't get to your question today, and you feel a need to talk to somebody, we're certainly here to help. Feel free to give us a call if you have questions that you need answered, questions about the plan, about your own individual account, or about your own individual retirement circumstances. Certainly, we have people on staff that want to help you deal with those things. We'd certainly love to hear from you. So do give us a call. With that, I think I'll just thanks to Brent and Tammy and to Nicole and Kirby in the background to help us deliver this. And certainly thanks to all of you who have attended. It was great to have you come out and give us this opportunity to speak with you. So thanks again, and have a great night, everyone.